Welcome to Unsuitable on Ray Radio, the award-winning financial services and business advisory podcast that challenges your old-school business practices and the traditional business suit culture. Our guests are industry professionals and experts who will challenge you to think beyond the suit and tie while offering you meaningful modern solutions to help you enhance your company's growth. I'm your host, Dave Kane.
As we all know, after 5 o'clock, a major part of doing business is networking. Dinners, social events, golf matches, concerts. I can't even tell you how much time I've spent on the golf course hitting a lousy score over the years, all for the sake of business development and client appreciation. So when the Tax Cut and Jobs Act was released late last year, there were a lot of business owners scratching their heads about how to handle their entertainment expenses going forward. It was pretty clear that expenses related to entertainment, amusement, or recreation, and most anything that was fun would no longer be deductible. But what about meals, and what about any food and beverages consumed during an event? Chris Axene, Ray's own tax reform development bloodhound, has been following this particular provision very closely and was pumped when the IRS finally released additional guidance. I'm pumped up today because today I'm finally going to learn if I can deduct my beers and meals at the grill room after a round on the golf course with a client. Welcome back to a long-term guest of Unsuitable, Chris Axene. Welcome, Chris.
Thanks, Dave. I'm glad to be here. And first of all, thank you very much for taking one for the team all those years at those miserable golf outings. I know you really were not looking forward to them, and I appreciate that you did that for us.
Well, you know what? That's all going to change now that we can't have a beer while we're playing.
Well, so hot off the press.
Hot off the press.
And the good news is the IRS did us a solid. And so, as you teed up in your intro, with the Tax Reform Act that was passed at the 12th hour at the end of last year.
Don't be so salty about that.
I know. Well, what happened is Congress snuck in there a provision that said, hey, by the way, entertainment expenses no longer deductible, incurred after, starting in 2018 and later. It was a surprise for all of us. We weren't expecting that, and the short answer on that is they were looking for pay-fors.
Sure.
To pay for other things that they gave the taxpayers in the code. So we knew entertainment expenses weren't deductible, but what we didn't know is, because Congress didn't give us any other guidance, because that's the IRS's job, was whether meals and the meals part of that, the meals and the beverages were caught up in that 100% non-deductibility requirement going forward. And we've been languishing there for 9 months. And myself and all the other professionals out there pontificating one way or another, thinking that I think you're good, or maybe we're not. And bottom line was, hey, we're hoping the IRS gives us some guidance.
We just didn't know.
We didn't know. And the good news is, as of last week, hot off the press, is they came out with some guidance in the form of what we call proposed regulations. And regulations are the IRS's interpretation of the code and how they will implement what Congress intended. Proposed is they're not binding yet, but we can rely on them in this particular case. So
start amending estimates, quarterly estimates for these rules. Can we do that?
So the good news is the steak dinner is deductible again.
Oh, it is?
It is.
Okay.
So it's subject to all the rules we used to have with regard to business meals, substantiation and ordinary and necessary and not lavish. So those are still around, didn't change, not impacted by any of this. But when you go to the Clippers game and you buy the Cracker Jacks and a beverage, the good news is that we can deduct at least 50%.
Diamond Dog still deductible?
Well, it is, but you know what? I would refrain from buying enough of those dogs to make the deduction worth anything.
Yeah. So I want to go back. What you hit is that, hey, the steak dinner is deductible, but just like it has in the past, but just as it been in the past, you have to have the proper documentation and substantiation. So I think that's worth repeating, because that's something that's often overlooked. So what do I need to deduct that steak dinner?
Yeah, right. So good question, and we see this on audit, because the IRS knows it's an area where the compliance maybe isn't as great as it could be. And that's what we call the 5 W's. So the who, what, when, where, and why.
Okay.
And that, with regard to business meals, whether it's at a lunch during the middle of the day or at the baseball game at the end of the day, the meals part of that requires the 5 W's, and it really needs to be contemporaneous in time. So when you get that receipt, you're writing on it, who are you entertaining? So it must be, under the rules, it must be either a current client or a prospect. Could also be a referral.
Right. Sure.
Partner.
Has to have a business purpose.
The business, what you were meeting about, the context of the business conversation you had, and who was there from both sides, and then the where and the when, all that should be evidence already on the receipt.
So the documentation is just as important as it's ever been.
That's right. And on audit, if the IRS drills that far down in the details, they will ask for the receipts and they will want to see that. And if there's nothing there, that's not going to be a good...
You're toast.
That's not going to be
You're
a good
writing a
answer.
check. You're writing a check.
Yeah. So the trying to rely on the memory is not something you want to use in this area.
So, before we leave that area, and we hear this a lot, I've heard this a lot, and I'm not sure sometimes how to answer that. Hey, I put that steak dinner on my credit card, and I pay my credit card bill every month, and that should be enough of the documentation. Is that really true? Do I still have to meet the 4 W's or 5 W's or whatever?
Sure do. Yep. So
Okay.
so the credit card statement does nothing more than maybe certainly it gives you an amount. Depending on how the vendor is set up, it's possible that the where isn't going to be there because it has some nondescript name that may come through on the statement. That may not, for example, going to the Clippers game and getting a receipt that says Huntington Ballpark, okay, you might know where that is. But if you get on the credit card statement, it shows up as, CC something Inc.
You don't know what
You don't know what that is. And so you have those two things, and then of course you don't have the who attended and why did you have it.
I did want to share with you, and this may impact some of your future answers. The 3 highest markets that listen to Unsuitable on Ray Radio, it's the Cleveland, Akron, Canton area, Columbus, Ohio, and then the 3rd highest is Washington, D.C. So I just want to let you know your buddies over in Washington, D.C. are going to be listening to your podcast.
Well, I've got some advice for him.
You do? Okay. Okay, take a second look. But Chris, why do you think it took, was it 9 months, almost 10 months, to get this in front of our clients and the practitioners?
Well, yeah, good question. So the IRS as an organization has been dealing with a limited budget for many years, in part because Congress has refused to increase their funding because they didn't feel confident that the agency was being run in an effective manner and effectively using taxpayer dollars. Of course, the agency uses that as an excuse to say, well, we can't do our job because we don't have sufficient funding. So unfortunately, some of the stalemate back and forth you get in D.C., I think, is somewhat involved here. But the reality is the tax code was so encompassing in the areas that were impacted, not just this area, but many others, that it's taken them this long and I'm not surprised in a way, and I'm hoping that we're not done yet. That they are other areas that they're going to be issuing guidance here before we get to the end of the year.
I want to back up to the credit cards. We have, a member of the audience. I think they're sick or they have a cold. They just threw a question our way about credit cards and said, well, so how do you account for purchases charged on a credit card for meals and entertainments? I believe that's the crux of the question, but it goes back. You still have to have all the documentation that you talked about earlier, the 5 W's.
Yeah.
No matter what you're using that credit card, there's no exceptions.
Right. So the 5W requirements in the code are that's the law.
Okay.
And so the credit card company doesn't know why you were there, and so they're not going to provide any of that information.
You don't get a free pass using
You don't
a credit
get a free
card.
pass. Now, so oftentimes what we see in our clients, particularly the smaller ones, is they will, their monthly credit card statement is $5,000 and it's got all kinds of things in it. They might have gone to Staples for office supplies. They took a client to the baseball game, and they just lump it into one account, and then you ask my accountant
Right.
account, and then it's up to the bookkeeper here at Ray to go through and look at that and actually dive into the detail to then, it's kind of a holding account, if you will, to divide that back out into the various buckets that it needs to go into, including meals.
Right. Okay. I think it's appropriate if I have some questions, maybe just throw your way and say, hey, is this deductible?
Is this like the
And
Fast 50?
It's Fast 50. And you can say yes, no, or your famous answer is, well, it depends.
That's a solid answer.
That's a solid answer. So here we go. You ready?
I'm ready.
This is kind of like a little quiz show.
Can I dig in?
You can. Take a highly technical situation and see if we can have some fun with it. Country club dues.
Non-deductible.
Non-deductible. Not even might take clients out.
The dues part is non-deductible. Hasn't been deductible since you started practicing.
Social clubs.
What do you mean by social club?
Supper club.
Yeah, non-deductible.
Non-deductible. How about Rotary, Kiwanis, Lions,
Deductible.
Elks?
That's good.
Elks
Well,
deductible?
no, let's keep it.
Oh, no, wait. Yeah, Elks deductible?
No.
Okay. Health clubs, spas, gym memberships.
Generally, no, but there may be a deduction on the personal side if you get a doctor to sign off on that you need it.
Okay. I noticed today you're looking a little dapper in your outfit. You look
I
like
dressed
you're-
up for the podcast.
Yeah,
'cause,
yeah. So is that specialized clothing deductible that you're wearing today?
It is not.
It's not deductible.
Not deductible.
Just for the CPA profession, or if you need
Period.
Period.
Yeah, this is capable of being worn on Sunday just as it is today, so non-deductible.
If you wear scrubs to work, do you get to deduct those?
Well, so now that's interesting. Scrubs, you get tied into a specific profession. So perhaps there's a way that could be deductible for medical professionals who have to wear them.
So there's always discussion. There's
Yeah.
something. Never really say no, but you've got to ask more questions.
You do, and I have an example of that. Is I have a client that is in the medical profession that he sees patients and his uniform is a suit, and he likes to shop at Nordstrom's, and he feels that because that's his uniform, he should be able to deduct that.
And
And if you've heard what I've said today, what do you think the answer to that is?
the answer is no.
No.
Absolutely not.
That's
but
right.
the business can still pay for it, correct, but not deduct it.
Right. So that's right.
So the business can still pay for my country club dues, but not deduct it.
Right.
I mean, there's a little bit. Is that income to me?
Well, the answer is it depends.
I knew. I was waiting for it. I was waiting for that.
I didn't even try hard.
Okay,
not
let's
to say
move
it.
on. I don't know that we want to answer that question here. The client's listening. Come on in. We'll have a conversation and
Right.
we'll look at the facts for you. On
I need
that.
to go on a fact-finding mission to the particular club in order to answer that.
Sure. Employee lunches.
Yeah.
Okay. Do I have to have all those documentation for employee lunches?
So we had the tax law changed a little bit. The employee lunches.
Okay.
Used to be there was the ability to, if they were infrequent and for their benefit. An example of that might be a busy season lunch or busy season dinner. They're working long hours, etc. That the company could deduct 100% of that. Under the new tax law, that has been reduced to 50, but it's
Okay.
otherwise deductible at that threshold.
Client holds a training session, has food at lunch, and after work they go out, have hors d'oeuvres and cocktails.
For who?
Everybody that was there.
And who was there? Employees only?
Employees.
Yeah. So generally
You're
speaking,
gonna give me that one, huh?
that should be, but again, not every week. So we get back to this kind of line in the sand, so to speak, of how frequent is it.
Well, training can happen daily if you're into it.
So if you're going to the bar every day after your training, that's not going to fly.
There's a discussion to be had there. And again, I think it's interesting to point out, I mean, you and I have a lot of fun with this stuff, talk about it in a, high level, technical, and then kind of go through this thing. But, at the end of the day, you have to sign a tax return, as will our client. And that little small print on there says that, you're correct and accurate and et cetera. So, there are penalties for all involved if you're signing those returns.
Right.
And taking responsibility for certain expenses that just aren't.
Right.
Right
And back to my client example of, my advice to him was, yeah, you can go continue to buy your suits at Nordstrom and expense them to the business, but I'm going to continue to go look for it and find it and add it back on your tax return, so you're not getting a tax benefit for it.
What about airplanes and fast cars?
Well, it depends. Pass.
Okay. All right. That's a conversation. Again, let's frame that conversation. That's a conversation that needs to be had. A lot of facts behind closed doors, because what may work for client A probably doesn't work for client B, and so forth.
The rules for aircraft in particular are very complex when you look at the main reason why the main expense that the client wants to be able to deduct as quickly as possible is the cost of the plane through depreciation. And there's some pretty technical and complex rules that apply to in order to get the fastest write-off that you can.
I think we talked about a little bit of why there was confusion early on about what was deductible following the release. Just so we cover that, we covered all the confusion. We're good to go with entertainment expenses.
I think so. Entertainment non-deductible. That's the bad news. Meals part of it, deductible. We've kind of covered the easy part of that is when it's separately incurred and purchased. So you're sitting in the stands. The other example of that where maybe it gets a little complicated is, let's say you buy the box and then it comes with catering, and so then it can get complicated in terms of the invoice you get.
Okay.
Does it have one number on it that covers both? Or is it separately broken out? And the answer on deductibility depends on that.
Okay. All right. Now we're getting into the good stuff. Okay. So I invite you out to the country club, of which my dues are non-deductible. We have breakfast. We talk business. That's deductible. What about the round of golf? Is that entertainment?
Yeah, that's entertainment.
Non-deductible.
In spite of when you play with me, and I know you get zero entertainment value out of it, it is entertainment.
It is entertainment. So again, those golf matches, non-deductible. The meal before and after, and you're talking business, is deductible.
Right.
Okay.
Remember, you got to have the 5 W's, and as long as they are present, yes.
Okay. What about situation where you have a client appreciation dinner for a client and his or her spouse, that is not involved in the business? Would the spouse's meal be deductible?
Yeah, so good question, and generally speaking, the answer is yeah. You
go for it?
You go for it.
Man, you're softening up in your days.
Well,
it's
the end of the day.
How about it's the end of the day. How about that airline ticket? I'm going out to convention out in Vegas, taking my spouse. Clearly, the convention's business related. It's the top, podcast host convention out in Las Vegas, so clearly deductible. If I take my spouse, is that deductible?
We probably crossed the line at some point between the cost of a meal for the spouse and the airline ticket and the hotel.
I just didn't know I crossed the line.
You just didn't know you crossed it, yeah.
Again, that's again, we laugh about that, but those are types of things that you have to have discussion with your advisor, because there are different cases in most instances where we have to have the facts.
Yeah, that's true. And look, I think you could construct a fact pattern using the spouse is going someplace where you could get the deductibility because of the nature of what the spouses are going to.
Right. Anything else on the horizon that we need to know about that you can fill us in the next few minutes?
Well, so the other guidance that came out that we were hoping for was not in the entertainment area, but in the pass-through deduction area, 199 Cap A. So I don't know how far you want to dive into those weeds on this call, but or this podcast.
We'll have another session on that. That's pretty deep.
That it warrants its own session, but the good news is we got some guidance on that. That covers some of the questions we had, and so that's helpful.
And just to expand on that, pass-through entities. When you use that term, you're talking about S corporations and LLCs and partnerships
And sole proprietors.
and sole proprietors. Okay.
And trusts and estates. So
Okay,
things
so-
that issue a K1 to an owner.
Okay. Lots going on there, folks. Call Axene. He can set you up. And I think you also shared with me, and there's something going on with LLCs and self-employment tax that we need to be aware of, or is that still being kicked around?
No, so, and that has nothing to do with the new tax law, but it has everything to do with the evolution of case law as it applies to taxes with regard to LLCs, taxed partnerships, and the self-employment tax on income allocated to them on their K1. And there was a position in the past where as long as you were paying the partner what we call a guaranteed payment, which is a salary,
Right.
a reasonable salary, that you could exempt the income allocated to them from self-employment tax.
You know, how long we've been waiting for that piece of guidance?
Well, the IRS,
some years?
Yeah, the IRS originally proposed regulations in 1997, and Congress came back a year later and said, nope, this is our area to give guidance on, and then they never did.
Okay. You know, Chris, in a couple minutes we have left, I think it's always appropriate when we talk about, the tax law and the tax cuts. Any winners out there that you're running across? I know it hasn't been truly tested. Any winners out there?
Well, so with any major tax reform, there's winners and losers. I think on the individual side, I think there is going to be a bit of a hangover come April when everybody is filing their tax returns. What I would say is, and I say that because Congress monkeyed with the itemized deductions and capping the state and local tax deduction piece of that. They got rid of personal exemptions. If you are a middle-income family that has kids that are under 17 or under, I think you're probably going to come out ahead under the new law than the old law. If you are somebody that has kids older than that are still at home and still dependents, you're probably going to come out on the other side of that scale, unfortunately.
So are there any other patches to the tax law on the horizon?
Well, Congress right now actually has, and I think it's in the House, there are 3 bills, separate bills, that are all tax 2.0, tax reform 2.0 related, that are out there. Whether or not they go anywhere, it remains to be seen. I am highly doubtful that anything gets done, certainly before the election in November. And if we lose seats on the conservative side, then the likelihood is even less after that. But technical corrections to, as well as all the changes on the individual side and the estate and gift side are temporary and will expire. And so that's what some of these bills are doing, trying to make those permanent.
Okay. Action plan, a couple takeaways for our listeners.
Well, year-end planning is key, particularly this year, and we're doing this within our current client base. But is see your accountant, make a date to have a conversation and run projections so that you aren't surprised when you come in April to file your tax return.
So planning,
Yeah.
planning,
Planning,
and more planning.
Right.
Has anybody ever referred to you before as a bloodhound?
No, maybe a leech, but never a bloodhound.
That's quite a compliment. Our guest today has been Chris Axene with Ray and Associates, and as you can tell from the discussion, Chris is head of our tax strategy and implementation group. High priority on planning and all around good guy. Never post a score, so we don't know what his true handicap index is. So, buyer beware.
Thanks, Dave. I appreciate that.
Thanks again for joining us, Chris.
Yep, we'll see you next time.
All jokes aside, the business meal expense deduction is a big deal for many of us, as are those credit card charges and a lot of other business-related expenses. So I know our listeners appreciate you breaking it down for them in a rather comical way, so appreciate the presentation. Hey, listeners, we've accumulated a wealth of information and educational resources dedicated to the Tax Cut and Jobs Act. Be sure to check them out. To get to them, just look for today's episode at raycpa.com/podcast and scroll through the additional resources section of the page. If you enjoyed today's episode, we want to know. Like it, comment on it, or share it with your colleagues. And don't forget to check out videos of our podcast on YouTube. Until next time, I'm Dave Kane, encouraging you to loosen up your tie, think outside the box, and grab a steak.
Deductible.